How have the markets been reacting today with the news of what's taken place with Iran?
Well, what a day, really. We really had that sort of classic risk-off move this morning with a rush to safe havens. We saw treasuries bid, the yen bid, gold breaching $1,600 an ounce. So it was really a classic textbook response to this heightened geopolitical risk environment that we saw. But throughout the day, I think the consensus formed that potentially because Iran had limited their attacks to military installments and there were rumours that potentially US troops had managed to evacuate the strike regions beforehand and that there were zero casualties reported on US news networks, we saw a lot of those moves reversed very quickly, actually. We saw dip buyers stepping back into the market and we saw normal trading ranges resume. Really because I think the key here was the fact that this zero US casualties is seen to mean that Iran really sort of escalated to de-escalate. We knew that they were going to retaliate in response to the killing of Soleimani. US military were prepared for that, and that's what we've seen. And now we've also seen that the US president as well is delaying his address to the nation for the morning US time, and that's seen as some restraint.
I think he tweeted that, saying he'll make a statement in about 8 hours, 9 hours from now, which is quite a considerable kind of measure of restraint, I guess, if you could call it that. Is the market building in some anticipation of what that American response might look like?
Yeah, so I think the market at the moment is really sort of taking a sense of calm from that. The fact that President Trump is being quite restrained at the moment, the fact that we haven't seen a flurry of tweets all over his Twitter account really means that markets can, I guess, build a sense of optimism that potentially the US side right now are not going to retaliate. Potentially there's been limited US casualties, and that means that maybe we've got a real chance right now for diplomacy between the US and Iran. So I think in that sense, the markets can really take a breather. They can pause and they can wait and see. But I think this sort of heightened geopolitical risk environment does really play into markets in that it's the absolute polar opposite to what we've seen driving markets throughout Q4 of this year, which was really abundant central bank liquidity and receding geopolitical risks was the narrative. So that means that we are going to have ongoing, certainly aggravated headline risk for the next few days, I would say, at the very least.
From an economic perspective, where is Australia most exposed here?
So I think Australia would be most exposed, obviously, through the spike in oil prices. At the moment, we've seen oil prices come off a little bit, given that we haven't seen any attacks on oil-producing assets. We've actually seen the attacks limited to military installments. But I think if we were to see any sort of escalation over the next 24, 48 hours or so that did bring into play those oil-related assets, then we could certainly see an impact here in Australia via the increased oil price. And we have seen over the last few days as well that the sort of rate cut bets for the RBA in February have stepped up within the market. A lot of that to do with the oil price increase that we have seen over the past few days, and also obviously to do with the bushfire crisis that we see ongoing in Australia.
And that is perhaps the most immediate concern for us right now, the cost ultimately of this bushfire crisis. Season's not even over yet. Where do you begin modelling the impact that's going to have on the Australian economy, given that it is so vast?
Yeah, I mean, it's incredible, and the enormity of the disaster is actually quite daunting. So in terms of economic modelling, it's very difficult to gauge at this stage. Obviously, we can't sort of produce any final figures because we're not even halfway through, I would say.
I've seen figures ranging somewhere between 2.5 and 5 billion. Does that roughly line up to what your expectations might be?
Yeah, I think that would be roughly in the region of what we're expecting, but I think a lot of those figures as well don't include the sort of long-term impact that we have of climate change. So I think obviously we have the sort of one-off impact that it's certainly going to hit the Q4 19 GDP figures and as well the Q1 2020 GDP figures, but I think we as well have to factor in a real sort of long-term scenario where actually the effects of the warming planet are going to be visible within Australia, and we are going to see that impact potentially the valuation of multiple financial assets, potentially of mortgages as we see water levels and sea levels rising. So the list goes on, really.
What about pressure from elsewhere, particularly in the corporate sector, about how those valuations are done?
Well, it's a very interesting point, and I think that that's why we see at the moment that Scott Morrison is really facing not only a political clash with society, but also with investors. Because if we look at global capital at the moment, there's around a third of global capital is invested with some kind of ESG mandate. And if we don't see credible climate policy in Australia, then we are going to lose out in that respect. And it's not necessarily because I'm saying we have to be green or we don't have to be green, but it's actually because the economic cost of this crisis is going to force change. And that's why we really need to see, and I think we are going to see from the government a potential much larger response than we have already seen. I would say the probability of an increased fiscal spend has potentially increased now. Certainly,
that $2 billion fund was announced yesterday. That's just the start of it.
Yeah, exactly. Well, I mean, it's not really much if you consider the scale of the damage. I think we need a lot more. We not only need something that goes beyond bushfire relief, but a real credible fiscal package and credible climate change policy as well within Australia.
Is there a tipping point in your mind of the cost of inaction versus the cost of action? And where is that point from a monetary point of view?
There certainly is a tipping point, and I would say we are fast approaching that inflection point. I think at the moment we're seeing that not only the sort of political cost to Scott Morrison's leadership at the moment, you only have to, I mean, we haven't seen any official polls released, but you only have to look to social media, to Twitter, to see that his leadership at the moment is in disarray and is in tatters. So we've got that sort of social cost there. We've also got a social cost coming through potentially over the next 12 months in the fact of increased food prices. We're seeing a lot of regional trade being cut off by the road closures. We're potentially going to see a decrease in agricultural productivity, and that's really going to lend itself to increased food prices. And that's not just in Australia, that's actually throughout the world. Climate change is inhibiting agricultural productivity. We're seeing that in Africa, Indonesia, India with onion prices. And I think that that's something that's really going to cause policymakers to sit up and listen, because if we do see that increased impact of food prices impacting the household budget, then that's something that policymakers are going to have to correct.
And there are already signs that it's hurting consumer confidence as well. You see that as a long-term issue that the government needs to deal with?
Oh, yeah, you're exactly right. I mean, yesterday we saw confidence figures released. Confidence is at a 4-year low amongst consumers. We also saw confidence in the future economic outlook was at lows we haven't seen since 1994. So if that doesn't make the government sit up and listen, I don't know what else will. And this is coming at a time when really we can't afford consumption to take more of a hit within Australia. We're already seeing that economic growth is particularly weak at the moment.
Wages are stagnant. That's
yeah,
an issue
exactly.
as well the government's been dealing with before this crisis even erupted.
Exactly. I mean, consumption is already taking a hit because the Australian consumer, as we know, is heavily over-leveraged. They are choosing, as we've seen in the most recent national accounts data, to deleverage, given that they aren't receiving any income growth via wages, and given that they are so heavily over-leveraged. And this confidence hit is only going to make that even worse. And particularly as we see the fact that the labour market is only set to deteriorate over the coming year. We also saw yesterday ANZ job ads release, which point to, I think, an almost 14% decline year on year. And that really points to the fact that potentially unemployment is only going to rise further. And it is already well away from the RBA's full employment targets, which means that they are going to have to inject further stimulus into the Australian economy in order to meet their full employment and inflation targets.
So that recovery itself from the crisis is not enough of a stimulus on its own?
Sorry, what's that?
The recovery from the crisis, this $2 billion fund, for instance, where you go to rebuilding towns and infrastructure, how much of a stimulus does that provide to the economy of its own?
Well, I think it's somewhat perverse in that we will see potentially in the sort of Q2, Q3, Q4 figures this year a boost to GDP from, as you say, that rebuilding. But I think what we really need to consider and what Australian society really needs to wake up to is the fact that we're going to have a long-term economic drag and a lasting economic drag from not only this bushfire crisis, but from the impact of climate change. Not only will this impact tourism, which at the moment is our fourth largest export, and as the world shifts away from using coal and iron ore as a resource, Australia needs to find other industries to back that up, and tourism is a key focus point. And if we see our country mired by the effects of climate change, that's not going to happen. So we really need to to address the long-term economic impact as well, not, I guess, the short-term GDP boost that we might see from the rebuild.
Eleanor Crowe from Saxo Capital Markets, always good to have you. Thank you so much.
Thank you for having me.